Jeff, first of all, that's a very, very good way to put it. And the Peter Fisher meeting was memorable. And
In this interview with Jim Rickards, he delves into the intricacies of Wall Street's actions during a financial crisis, drawing from his own experiences and historical events. He emphasizes that during the 1998 crisis, it wasn't the Fed that bailed out the failing institutions, but rather Wall Street itself. Rickards highlights the importance of risk management and recounts how his involvement with long-term capital management, LTCM, shaped his understanding of financial agreements. He describes how LTCM's carefully crafted contracts prevented counterparties from terminating agreements even as the fund faced massive losses. Rickards also touches upon regulatory issues regarding reporting positions to the SEC, illustrating the complexities of financial transactions during turbulent times. Overall, the interview provides insights into the inner workings of financial markets and the role of both institutions and regulations in managing crises.
I wrote about it in one of my books, The Road to Ruin. I had a chapter on it where I just described it in a lot of detail. But what was interesting about the meeting, there are a lot of misconceptions, but the one is, the Fed came along and bailed you guys out. Well, they didn't bail anybody out. They precipitated a rescue. There was a rescue and a bailout, but it was done by Wall Street. Now, the Fed got everyone in the room and knocked heads together and made it pretty clear that they had to go do something, but it was a private rescue at the end of the day, number one. Number two, the Fed had no idea what was going on. I mean, there was a little bit on the CNBC or whatever, but we did. We, despite the massive failure of risk management, which is pretty obvious, our accounting and financial controls were excellent. We knew exactly, like to the penny, how much we were losing every day and what was going on, et cetera. There are a couple of interesting things about that. Number one, you got to go all the way back to the 1991 bond trading scandal at Salomon Brothers. Salomon Brothers, who are they? But in the day, they were the biggest, baddest government securities dealer on the planet. And John Meriwether and Larry Hildebrand, Eric Rosenfeld, the other principals of LTCM, and Myron Scholes came out of Salomon Brothers. And what happened there was, it was a bad actor. He tried to corner the market in 2-year notes. He actually did briefly, but he had to break the law to do it because he said these were customer positions, they were house positions, etc. He spent some time in jail, but he told John Meriwether was his boss. He said, I basically broke the law here. So Meriwether, to his credit, went to the chairman, the president, and the general counsel, John Goodfriend, Tommy Strauss, and Don Fierstein. Well, what else can you do? You tell your CEO, you tell the president, you tell the general counsel that there's been some wrongdoing. You've done your job. But Breeden was the head of the SEC. He was on the jihad. All those guys got fired, and JM resigned. So he had to go spend a little time on the beach. And then he came back with the hedge fund, long-term capital management. We brought all these guys from Salomon Brothers, but that was a searing experience for them because they had seen, massive losses. There was actually a run on Salomon Brothers. Jerry Corrigan, behind the closet, bailed out Salomon Brothers because it was not long after Drexel. And they said, we don't need two massive failures of primary dealers in a row. So we got to bail out Salomon Brothers, and they did. And Buffett came in as a white knight, and that's all ancient history. But as it applies to LTCM, these guys, they were traumatized by that. So we started LTCM. I'm there on day one. I'm the lawyer, and they take me aside and they go, Jim, when we're entering into these swap agreements, we have to make sure of two things. We never have to put up collateral unless we get it. We got to get the collateral at 10 in the morning. We'll put it up at 4 in the afternoon. But we never want to be in a situation where we have to post before we receive, because they were all two-sided trades. They were all arbitrage. So that's the one thing. And no haircuts. I mean, our nickname was No Haircut Capital Management. So we would give you some, certainly mark to market. You have mark to markets paid in full, but the initial margin was pretty close to zero. And we want no material adverse change clauses. They never wanted to be in a position where the position worked, they were happy with the book, but somebody could blow you out or seize collateral, your prime broker could put you out. They never wanted that. They wanted it in contractually. So the funniest thing we did is our first big swap agreement was with Credit Suisse. And so I negotiated it. And we had $1 billion at the time. It was the largest hedge fund opening ever up till that time. And so the question was, where is the point at which we can terminate you? Not quite material adverse change, but termination clause. So Credit Suisse said, okay, $500 million, because that's down half. $1 billion, you're down half, you still have $500 million left, we can terminate the swap. So we agreed to that. So then the next one comes along, you're doing JP Morgan, Morgan Stanley, and UBS and all the rest. And every time the issue came up, I said, well, Credit Suisse agreed to $500 million, so we're not going to give you a better deal. They were the first dealer, so you get $500 million. And they all said yes, but what no one realized is that we eventually got to $7 billion. So if you have a $500 million termination clause, if you go from $7 billion to $500 million, I mean, you're toast. You're just it's a countdown to zero, right? But everyone agreed to the $500 million. So when the crunch came in 1998, what happened was everybody wanted to terminate us, and they all went to their lawyers, and the lawyer said, well, you have no rights until you get to $500 million. I'm like, are you kidding me? This is like $7 billion. They've lost 90%. But they couldn't do it. We had bulletproof agreements. But the backstory was that came out of Salomon Brothers. They never wanted to go through that, and they didn't. And so, take the two things I just described. Matching collateral. So collateral in, collateral out is never sooner or larger than collateral in. It could be a wash, but it couldn't be a net drain on capital, number one. Number two, the termination clause was so low relative to where the book started that you couldn't terminate us. We were all on the plane together, the 16 banks, and there were 19 lenders and $1 billion unsecured credit facility. We were all on the plane together, seatbelts strapped in. We were all going to crash together. Nobody was getting out first because the contracts, and I wrote them, were bulletproof. So everyone's like, what? And so it's just going down, losing a couple $100 million a day. Like I remember David Mullins, great guy, former vice chairman of the Fed. He was one of our partners. So we had, Fed insiders at the table. And I remember one day he looked up and said, can't we just make money one day? But it was just this steady erosion. It was heading to zero. So what we did, we called the Fed. The Fed never called us. We called them. Not for a bailout. We didn't expect it. We said that's never going to happen. We're a hedge fund. We're not a bank. They're not going to bail us out. But we were just being good corporate citizens. We said we see this plane crash coming. We just want to let you know, get ready because it's coming. And that's when Peter Fisher and the other guy who was in the room was Gary Gensler, who's Mr. Bitcoin. He's the head of the SEC. And Dino Costa's good quant, and JM and I. And it's exactly what you said. We spent hours going through the books position by position. As far as the equity markets are concerned, what nobody knew, other than Bear Stearns was our prime broker, we took 4.9% position. So 5% is when you have to file, I think it's Form 13D, you have to publicly say, I own this stock. First of all, it was 100% derivatives. These were total return equity swaps. So there was an issue. Well, do I have to report it publicly to the SEC if it's a swap? Well, no one really knew the answer, but it hadn't been litigated. But we took a conservative position. We said, yeah, if you do. So we went to 4.9%. But the combination of the swap and the 4.9 meant we never reported this. We didn't have to, and it was completely off balance sheet. But they were live positions.